Hello, everybody, and welcome. Today, we're going to be talking about how to compute trailing 12 months. So let's get to it. My disclaimer and copyright notice: the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. I will be using Investopedia.com because it's amazing, as well as sec.gov for this presentation. So let's just talk really quickly, and I'll make sure that we go to the very bottom of like what exactly is trailing 12 months. So for instance, once Apple, who has a September 30th or end of September year end, once they go through and report results as of September, more recently, they've just reported results from the quarter ended from September 25th or from October 1st through 31st. So their financial information, as we kind of look at it, is now like a little bit old. That's where trailing 12 months comes in. So what we're going to be doing for these, we're going to do it for two publicly traded companies today. One is going to be Microsoft. The other one is going to be Apple. And what we're going to go through and do is we're essentially going to compute those trailing 12 months. So as an investor, we can have a better idea in terms of how the company is kind of performing on an annual basis when considering the new quarters. And when we kind of look over here, I just want to kind of talk a little bit about what's the difference between a Q and a K. 10Qs are quarterly reports, and these are reviewed by accounting. Very important that the standard for a review is not the same as that is for an audit. And an audit is going to involve a lot more testing, and it's a very, very important difference. So if you are wanting to get the highest level, is you'd want to have an audited financial statement. However, for publicly traded companies, if they had to have audited financial statements every single quarter, that would probably drive the accounting staff nuts, and we don't want to see that happen. So, and the important thing to remember is that audited numbers should be, they're both going to be reliable numbers, but it just is kind of the standard of review that's done by the independent auditors, right? So the auditors are not signing in blood, but it's a very, very different scope and standard of basically of testing that they're going through and doing. So it's a very, very big difference. So, and the important thing to know is that if we were doing this for Apple as of June 30th, and we were doing trailing 12 months, by that time, about 9 of the months we're going to be looking at are going to be reviewed, just because that's how long it's been since their end of their year. But again, Apple, Microsoft, some of these larger companies, they're generally not going to make huge reporting mistakes. So the numbers you see are generally going to be what they are. The other part over here, and again, this is really for the investor. And if I look over here, it's like what you'll notice here, and I just pulled this up from Apple today, and this is as of February 19th, 2023. If you look PE ratio, TTM, what exactly does that mean? Well, the price to earnings ratio using the trailing 12 months, meaning from January 1st or December 31st, because that's all the information we have. That's what TTM means, as well as earnings per share. So again, it's a very important way to gauge the how over underpriced a particular stock is. So, and why do companies? And the other thing I oftentimes get asked about is, typically, what does a publicly traded company have to go through and file? They have to file 3 10Qs and a 10K. And this is why being a publicly traded company is so important or so expensive. You have to file one for the 3 months ended. And if we had a calendar year end, it would be showing 3 months ended March 31st. And then we would have the 3 and 6 months for our second quarterly report. The third quarterly report would show 3 and 9 months ended September 30th. And then lastly, you would have an annual report, which is basically going to be the 12 months ended December 31st. And companies, you generally want to be filing these on time. The SEC and your exchanges like NASDAQ and YSE do not take very kindly to companies that fail to meet their deadlines for filing. So just another kind of thought here. And the other thing you're going to notice is that Apple has, like, they're using September 24th. But why do companies don't all have December 31st year ends? Well, there could be a lot of different reasons, but one of them is going to be, in my opinion, it's going to be cheaper audits, or now it's like, given the accounting shortage that's happening at auditing firms, there's too much work. And if you can have audits that are kind of spread throughout the year, because the amount of resources that it takes to get an audit done as opposed to a review, again, it's going to be, you're going to see different companies have different audit or year-end dates. For Apple, September 30th, why did they choose that? I have to imagine it's because the company is so large and so massive and has global operations. It's going to be a heck of a lot easier to do that than as of December 31st. Home Depot, Lowe's, and Macy's, Target, they'll typically have a year end, like you'll see retailers have one as of January 31st. And why is that? Well, it's partially if you had like a lot of year end returns after the holiday season. By staggering your year end to about a month after the Christmas season, you're going to make it a little bit easier for everybody else. Meta Platforms is as of December 31st, at least last time I checked. So you have, like, different companies have different year ends. And there's just a variety of reasons. What you would typically see for not-for-profit companies, or that those are not publicly traded, but they are publicly funded and supported, they're going to typically have June 30th year ends. That's what I usually will see with most not-for-profits. Okay, so this is a little bit about trailing 12 months. Again, we're doing this as we're pretending we're investors. And if you're taking one of my classes and you happen to have, or you're doing an update of a previous project or paper, this is what I'm going to have you go through and do. Okay, so we're going to go ahead and now go to the computing of the trailing 12 months. So Apple has their year end is basically September, end of September. Okay, so their time frame is from October 1st through September 30th. Now, Apple recently releases their Q1 results, and that Q1 is going to be, because their year end is as of September 30th, their quarter end for the first quarter is going to be December 31st. So how do we go through and create the trailing 12 months? So what we're going to do is we're going to use the 10K for Apple. We're going to get the annual results, and we're only doing this for the income statement. I'm not going to do this for the balance sheet. And it's September 2. This is our example. We're going to get the 10Q for the most period because that has the information that we need. We want to get those most recent 3 months, right? Remember, it's February 19th, so their second quarter won't happen until the end of March. So, and then also in this Q, because of comparability, when we want to show income statements side by side, we'll have the 3 months ended December 31st, 2021. So the way we're going to determine the trailing 12 months is we're going to take the full year, which is from September 24th, 2020, September 24th, or whatever, September 24th, 2021 through September 30th, 2022, we're going to get rid of that 2021 portion because we want to see the trailing 12 months or the full year. And then over here, then we're going to add in the most recent quarter. So let's go ahead and kind of take a look to see how we went through and did this. Now for Apple, I've kind of pulled up the income statements over here. But I do want to just kind of show you, like, well, Bennett, like, where did you get these and where did you get this information? So when you look at, I have other videos about this, but if I come over here and I go to sec.gov and I go to company filings, and I'm going to type in the name of the company, or a lot of times I like to use the ticker symbol, which it's now working. So if I type in AAPL and I have my investor toolkit on, which I usually recommend, I come over here and I say, oh, 10K annual reports and 10Q quarterly reports. So if I come over here to the 10K, and what I'm going to do is I'm not going to click on this necessarily. I'm just going to click on the filing button. When I click on the filing button, I can actually see the 10K in its entirety, which is right over here. We got Apple. But what I want to go to over here is our interactive. When I come over to the interactive data, what I can do is I can quickly go down here to financial statements. Now, the income statement for Apple, they don't call it an income statement. They like to call this fancy consolidated statement of operations. That's the one we want. We do not want comprehensive income. That is something else, but we want the consolidated statement of operations. So this is going to tell us right over here, like values right over here, and we're getting down to our net income. So what I've done conveniently is I copied this and basically put it onto a Google Sheet. So this over here is basically coming from our information over here of what I just basically pulled over and through. Now, so I've got now the annual report, which is, this is really giving me from 9/26/21 through 9/24/22. Now, Apple recently released their 10Q, which is right over here. And I pulled up the wrong one. Hold on. Oh, perfect. Okay, so this is going to be their quarterly report. And if we were to kind of go through and do the same thing, I look over here, 10Q. This is going to basically, again, this is going to be for Apple Inc. Come back over here, go to interactive data. I'm going to look over here for the financial statements. I'm going to go over here to condensed consolidated statements of operations. Notice here it says unaudited, right? So it's very, very important that when you're going through and doing a review, that it's very, very clear that it's not the same standard as an audit. So what we're going to do is we went through over here, we copied this over here, and now we're going to get a better sense in terms of what things are happening. Okay, so what I'm trying to do, and this is over here, this is really going to be 9/25/22 through 12/31/22. So what I'm trying to get is I'm trying to get from January 1st, 2020, January 1st, for the trailing 12 months, January 1st, 2021 through December 31st, 2022. But I've got a problem. This number includes 2021 numbers. So what I'm going to need to do is I'm going to have to back out that value, because right over here, this is 9/26/21 through 12/25/21. So what I'm going to do first is to get the 9 months, right? And this is going to be the 9 months from 12/26, or I should say 12/26/21 through 9/24/22. Again, Apple has a funky year end. We're only off by a few days here. We're going to go over a few days, not the end of the world necessarily. How do we get that? Well, we're going to take the full year, which I'm going to call A1, and I'm going to basically subtract C1, or basically these 3 months. So if I take A1 minus C1, what I'm going to get right over here is roughly 273.83 for net sales. And if I continue to kind of go through and copy these down, and then I do the provision for income taxes, and then I'm going to get to my net income. Okay, so again, what are we doing here? So notice here, the gross margin I could also kind of go through and subtract out the values. But over here, though, right, it's actually, this is really a function of, well, 273.83 minus 153.844 should give me 116.539. So this is really adding or subtracting the cost of sales from the net sales. Similarly, over here, total operating expenses is really going to be the sum of these two values, whereas this value here is I'm taking the full year amount minus subtracting the 3 months, which is over here, to get to that 9-month value. So I've got my 9-month value so far, and we'll call this D1. Now, what I'm going to do over here is I'm going to take B1, which is going to be my 3 months, basically from 9/25/22 to 12/31/22. So I'm going to basically bring these over here and so 393. And then over here, my provision, just take it over here. And then I'm going to have over here my 29.99. So I'm just basically bringing over this information over here. So this is my 3 months. So if I take the 9 months plus the 3 months, this will give me trailing 12 months, 12/31/22. So if we come over here, if I'm adding these up together, okay, and then we've got okay, and then our provision. Okay, so as we can kind of see, right? So for the trailing 12 months, and then so this is what I'm going through and computing. And if I just kind of go through and kind of just check some of the numbers, right? So if I take this, I'm basically taking 113,965 minus the other expense, coming down to my income before income taxes. But if I'm going through and just kind of checking my results, these will go through and work. So this is my trailing 12 months. So it's $95 billion for basically the year ended. Now, if we look at this and kind of say, well, does this really kind of make sense? Well, as we can kind of see is that kind of coming off the pandemic, our income has slightly dropped in terms of sales, cost of sales, so my bottom line net income for the 3 months dropped by about, 5 billion, or maybe 4.5 billion. So again, it kind of would make sense that my trailing 12 months is basically less than this value because this had this number over here. So that's how we go through and compute trailing 12 months. Again, this can be something useful for us in terms of going through and analyzing companies. So we've got our trailing 12 months, and let's do this for another company so we can just be sure we're going through and doing this properly. So we've gone over here and we've looked at Apple. Now what we're going to do over here is we're going to look at Microsoft. Microsoft has and the reason why I chose Microsoft is that they have a June 30th year end. So when they came out recently and basically released their quarterly results, and this would be for their second quarter because it's 3 and 6 months ended. So what we need to kind of go through and do is for this June 30th number, and again, our goal is over here, we want to basically create trailing 12 months, or from January 1st, 2022 through December 31st, 2022. So let's go ahead and do it. Come over here. This is where I basically copy the numbers from. These 3 months numbers, I'm just going to kind of put these in red. We just are not going to need those numbers. Also, too, over here, I'm not really going to need these numbers over here because these were from, unless I was doing some sort of trailing 12 months comparison, but I'm not going to do that. We don't really need these numbers either, right? The thing we need to do first is that this over here is what we have as well. We've got from we have from 7/1/21 through 6/30/22. Basically over here for Apple, and we'll call this letter A2. So over here, this is going to be the full year. I'm just going to go ahead and copy these guys down right over here. And there we go. So this is basically the full year. Now, what we're trying to do is we're trying to create trailing 12 months. So I'm going to take A2. And what I'm going to need to do is I'm going to need to back out over here. We'll call this B2. And I want to basically back out 6 months from 7/1/21 through 12/31/21, which are going to be these results right over here. So I want to basically back out essentially these numbers over here from my full year. This is then going to give me essentially when I subtract these two values here, when I take A2 minus B2, we'll call this D2. So this will hopefully give me over here 1/1/22 through 6/30/22. So when I go through and subtract these. So I got my gross margin, and then over here, I've got research and development. I've got sales and marketing. I've got general and administrative. So my operating income is going to be my gross margin minus these results right over here. Check my work. There we go. Other income going to be right over here at 221. And then we're going to have, let's see. Okay. Perfect. And then my provision for income taxes. Okay. So now I've got over here the 6 months for 2022. So by taking full year, June 30th, 2022, subtracting 2021, I'm now able to basically get the 6 months, right? So this is 6 months, 2022, 6/30, right? But now I need 6 months, 2022, 12/31. So over here, we've got July 1st, 2022 through 12/31/2022. And this is what we are going through and calling C2. Okay, so over here, C2. Okay, so we'll just bring those values over. Okay. Now for trailing 12 months, this is going to be D2 plus C2. This will give us E2, and this will be from 1/1/22 through 12/31/22. So we're going to go ahead and add these numbers up. So what I'm kind of doing is, if what you've noticed is like these are the provision for income taxes. So these are being combined, but net income is basically determined by the income minus the provision. So what I'm doing is I'm also, and additionally saying 82,588 minus 15,139. I'm also going over here and going through and checking this through. And that's what I have over here. So as we go over here and look at the trailing 12 months for Microsoft, right, this is going to give us a little bit of a better picture, like a more current picture, because if we just looked at the audited financial results, those are already 6 months of it are already stale dated, meaning that they're not as current. So as we look over here at the trailing 12 months for Microsoft, what does that kind of tell us? Well, if we looked at it from, this is like the 12 months ended, their revenue or their net income is clearly declining. Their revenue, though, seems to be up. It's at 204 billion, but their cost of revenue is up. Their gross margin is higher, but they have higher R&D costs. Sales and marketing is slightly higher. G&A costs are also slightly higher. Their operating income is slightly lower. They have some other expenses coming through, and then their income taxes are getting higher. Okay, so again, but it's over here, like, why is the trailing 12 months important for us? This is not something that you would necessarily be doing, accountant, but possibly if you're going through maybe and running some analytical procedures to kind of see, does like the overall numbers kind of make sense as far as like the way we're going through and doing a review. You might go through, I would actually assume that you would probably be using it for that. But a lot of times though, again, it kind of comes back to when, when we go through here and see like, oh, what's the earnings per share? What's the price to earnings ratio? The trailing 12 months is actually very, very important for that because the stock price is real time. And if we're comparing the stock price to earnings per share from 6 months ago, that's not going to be a good comparison. So by updating this is giving us the best possible numbers. So, but that's it. I want to thank you for watching here today. Please don't forget to like and subscribe. If you have any questions, please feel free to reach out to me. Hope you enjoyed the video, and I look forward to seeing you on the next video. Have a great day.